Welcome to the show, Money in the Morning. That was weird. I just did that. Welcome to the show, Be the Boss of Your Money. This is what happens when you have a long day, you're a little tired, and you have two shows to produce every day. But either way, both shows are about the same thing, taking control of your money, not necessarily the same content, though. Today, we're talking about NVIDIA continues its breakdown. I know some of you might have thought its little rebound above 900 the other day was meaningful, but that looked to me like a bounce in a chart that otherwise looks somewhat broken to me. And Adobe cracks today. That one's going to hurt the NASDAQ futures tomorrow. It already is hurting them now. Mortgage rates tick up, yields tick up, but oil ticks up. Oil is particularly important because gasoline will start to it follows that. And if gasoline prices rise ahead of an election, that is not good news for an incumbent. So we're going to roll the intro and we'll get into a couple of quick things. I'll give you an update, and then I got to hightail it out of here. And I know you have to get to places also. While you're watching this, if you don't mind, give me a thumbs up or a heart or an applause or a celebrate, whatever reaction you have at your disposal, depending on which social media platform you're watching from. And of course, when you do that, it helps the cause. More and more people will see the show. Your contacts will see the show, your friends. And if you have any questions, please ask me in the comments. Even if you're not watching this in the replay. No, I said that wrong too. Even if you're watching this in the replay and not during the live, I will see your questions. So go ahead and ask me what you want. Keep it to finance, all right? And I will get back to you. And it's good for everybody. So here we go. All right, and we are back. First, I mean, this has been a magnificent week for weather. Finally, last couple of weeks, it's been so rainy here on Long Island. I thought we were going to start floating away. I mean, the ground is still soft, but we've had a couple of amazing days of beautiful 70-degree or near 70-degree sunny weather, and it is just about as good as you get. Long Island is starting to pop. Flowers are starting to come up. Trees are starting to bloom. A little early this year, actually. It's only the middle of March. It's definitely warm for this time of year. Well, the winters have been warmer. But let's talk about what's hot right now. So you are often wondering about the market and stocks and investments, the economy. It's all intertwined. So first, I'm going to do a little surprise for you. I'm going to give you a little surprise. I'm going to tell you what I think the biggest mistake is that people are making with their money. It's not the only biggest or whatever mistake, but it's a big one. And I'm going to give you a solution. The biggest mistake I think people are making with their money, one of them, is that they're not being tax aware for the future. And when I talk about taxes, I have to say I'm not a CPA or tax advisor. I don't give tax advice. But so far in as much as what I do, tax implications are a big part of it. That's what we talk about: IRAs, Roth IRAs, municipal bonds, things like that. So taxes do have a place in our conversation. I think people consistently underestimate or ignore how high their taxes will probably be in retirement. And although for many people, your tax bracket is lower when you retire than when you were working, tax brackets, it could still be higher. So maybe instead of a 28% tax bracket, you're in a 22% tax bracket, where you go from 35 to 32. But generally speaking, from what I have seen in my experience, and I've been at this for decades now, okay? People's tax brackets don't typically go down all that much. It's not like you retire and all of a sudden you don't pay taxes anymore. And taxes happen for a number of reasons in retirement. If you're making over a certain amount, your Social Security income becomes half taxable or 85% of it becomes taxable, depending on how much money you make, whether if you're filing single or joint. But then you have to take money, or many of us have to take money out of an IRA. And when you take money out of an IRA, it's like earned income. You pay taxes on it. You pay federal tax, you pay state tax. I didn't say estate tax, I'm saying state income tax. If you live in a state with a state income. So what happens is you don't realize that probably a third of your entire retirement accounts are not even yours. You have a partner. You're paying it's like paying a huge commission to Uncle Sam. And people get caught off guard by that. And if you have a pension, that's probably taxable as well. So taxes are a big thing in retirement. And what people need to pay attention to is the opportunity to convert their accounts from an IRA to a Roth IRA. When you do that, if you take money out of an IRA and put it into it, let's say you have a $200,000 IRA, and let's say you just move half of it to a Roth IRA, $100,000 into a Roth IRA. That's a $100,000 IRA distribution, which becomes taxable. So if you don't have the money set aside to pay the taxes on an additional $100,000 of income, then reconsider your decision. Maybe you should only move $20,000 or $30,000 or $10,000 of your IRA to a Roth IRA. But start and do it every year. Also, if you don't want to pay the taxes and you're working, you could contribute to your 401k plan, but change that to contributing to the Roth 401k. At least there, you'll start accumulating assets tax-free. Now, you miss out on the tax break that you would get when you contribute to a Roth. I'm sorry, when you contribute to a 401k plan. And some people will say, well, if you factor that in and invest that money in the stock market, blah, 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 but you don't. It doesn't work that way in real life. Okay, so you might miss a small deduction contributing to a 401k if you use the Roth 401k, but the key is you're getting a tax break on all of that money down the road. You're eliminating the need for ever taking a required minimum distribution. You're passing on an asset to your heirs, tax-free, and they have, once they inherit it, they have 10 years to take out the funds, so they get an additional 10 years of tax-free. And when you contribute to a 401k plan and you retire, if you contribute to a Roth 401k and you retire, and you roll that money over to a Roth IRA, now you don't have to take required minimum distributions either, which makes this another fantastic estate planning tool. There are a lot of ways that we work with our clients, stop them with taxes. I love talking to people about making smarter moves with their money. A lot of people mistakenly think that they'll just make so much money in the stock market, that their investing acumen is going to be so good that it eliminates the need for financial planning, that it eliminates the need to make smart money moves. I'm going to make so much money on this Bitcoin that I'm never going to have to worry about any of this other stuff. You do. And even if you're making $100,000 a year and then you go up to $500,000 a year and then to $1 million a year income, pretty good, right? But your lifestyle grows along with it. So you're really never getting ahead of the 8 ball. You're just growing your lifestyle. You're living well, maybe high in the hog. But the key is you've got to save and invest. And the key is you've got to do it in a way that's tax efficient, not just for now, but down the road. I'm hopping mad at one of my clients' accountants. Because I know after doing the research, knowing what this client's income is, he should be converting his IRA to a Roth IRA. And the attorney just gives a quick quip. Not the attorney, the accountant goes, yeah, you got to pay the taxes. It's not worth it. That's all the thought that went into it. The guy didn't put any thought into it. He didn't tell him you could fill up your tax bracket. He didn't tell him that you'll save money down the road. He didn't see anything. He just said, you don't want to pay taxes now. And that is what you get from a lot of CPAs. They're trying to save you money on taxes in the here and now, but they're not talking to you about 20, 30 years down the road what your tax bill is going to be. And I expect to see you in 20 to 30 years, and I expect to be accountable to you for a very long time. So I want to make sure we're doing the right thing today so that you can thank me down the road. So your future self will say, I'm so glad I work with you, Mitch. Okay, let's talk about a couple of other things. Let's go to the big screen. want to show you a couple of things, what we're looking at. These are the big stories right now. All right, I'm going to pop you over to screen 3. Pop myself up in the corner. All right, here I am. All right. Let's get rid of that red. Okay. Adobe. Adobe is one of the really big, well-regarded tech companies. It was recently at a 52-week high of 638. It's trading down over $60 a share, down over 10% in aftermarket trading. They missed revenues. Forecast isn't as good, but it's not as good as people had expected, as investors were hoping for. And here we are. Stock was as high as 638. Now it's 509. That's like a $63 stock going out to 50. That's a pretty sizable decline. And it's going through this decline without any resistance, without much holding it up. And then I think about what's going on with another high flyer. And that one is, bear with me one second, okay? NVDA. And NVIDIA down almost $30, $974 to $879. So that's like a $97 stock going to 87, down about $10. Is it enough of a drop to buy the stock, or is it enough of a drop to be worried that there's another shoe to drop and the stock is going lower? That really is the toughest thing to know. And I think for some of you, it might pay to wait and find out. It depends on you, how much risk you can take, and how long is your time horizon. But nonetheless, I do see some of these large cap stocks starting to break down. And even though NVIDIA tanked right after it moved up to a new high after its earnings release last week, the stock closed down $100 from its year high by the end of the day. And that was from 974 to 875. Well, guess what? It's 875, 876 in aftermarket trading right now, as you could see on the screen right there. Okay. Look at that. So that becomes the line in the sand. Does it break below 875? That happens, we have to start talking about technicals and where it goes next, which, in my opinion, from being a chart reader, would be lower. So it looks like, and Apple hasn't been doing that great. Google hasn't been doing that great. It looks like there's some breakdown happening, and it's just an observation. This is not buy or sell advice. This is my observation of what's happening. And I will also now take a look at oil. Oil, West Texas Intermediate crude, over 80. That's a big move. That was hanging out in the high 60s, low 70s for a long time. 81 is a big move. OPEC Plus is doing over a 2.5 million barrel per day cut, and they're sticking to it. And that means you should expect gas prices to go up. We're very sensitive as Americans to gas prices. We always look at the price of gas as we're going down the road. We're driving down the road. We look, we see. And when people start to see the price of gasoline go up, they start to get a little bit miserable. That's a tough thing for an incumbent president who's facing a re-election. It's a tough thing to fight. So we'll see. But I think that there's a couple of statistics to look at. The last 3 months of non-farm payrolls, the price of gas, are the two most important things to look at that will determine the winner of the next presidential election. So we have a while, not really a long while, but we still have many months, a couple of months to go until the next election. It's almost April. Okay, so what, 7 months, 8 months till the next election? It's going to go by quick. But those are the three things I'm watching. Oh, and one more thing. Oh, how could I forget? Interest rates. Interest rates, when the 30-year mortgage went below 7% and home sales started to go up a lot, like they were flying. But 7% is the line in the sand. So that bears watching as well. Yields, bond yields did go up a little bit today because inflation figures like the PPI, the Producer Price Index, Consumer Price Index, have come in slightly ahead of expectations. And it makes it harder for the Federal Reserve to justify its potential rate cuts at the end of the year. We might not get a rate cut. We might get one. We might get two. We might get three. I don't think we get more than that if we do. But every time there's a strong CPI or PPI number, consumer price index or producer price index number, you have to put off the Fed cutting rates a little bit longer. And that might be what's happening now. And the stock market is going to start getting used to that. And the high flyers in particular, companies that are flying high with high P ratios, those are the ones that get the hardest and first. I'm not saying a low P ratio is a good thing. I don't think it is. But I am saying stocks that have gone up a lot with a high P or that are considered richly valued, when they do take a breather, they take it pretty hard. And that's something to look out for. Are you an investor? Are you a trader? Are you in this market for the long term? You have to decide what kind of investor you are. I'm asked all the time, is Tesla a good buy now? I keep saying, I don't know. I don't cover Tesla. It's not one of my stocks. I can't know every single stock. Tesla's a big stock a lot of people know, but I never felt like I was adding value to clients' accounts by knowing Tesla, by being one of a billion people that know it. It's not my thing. I can't know every single stock. Is it a good buy? It depends on what you want, depends how much risk you want to take. It was a consumer discretionary company, companies that sell you things you don't need, but that you really want. You're willing to pay up for things that you want. You're not willing to pay up for things that you need. That's the way life is. We're not willing to pay up for toothpaste and toilet paper, but for Lululemon pants and Starbucks coffee, oh yeah, we want to pay up for that. That's what I mean. So anyway, those are the things that bear watching. Adobe, NVDA, the 10-year yield, the price of oil. Those four things are going to impact everything for the next couple of weeks. And the next earnings season doesn't start for another 3 weeks. So until then, we're kind of in a vacuum of information. Next week, we have a Fed meeting. It's not so much that the Fed's going to cut rates. We don't expect the Fed to cut rates. But we do want to hear what Jerome Powell's comments are in terms of what to expect next. But he keeps saying the same thing. We might cut. We may have seen the peak in interest rates, but we're data dependent. So there's no concrete news to hang your hat on. Sometimes people get bulled up, sometimes they don't. Thank you so much for watching. I really hope I added some much needed perspective to what's taking place in financial news. And until then, I want to wish you all a happy Thursday evening. I'll be back Monday, unless something crazy happens in the market tomorrow, in which case I'll definitely hop on for a quick live stream. Have a good night.